So the focus of the workshop. What we'd like to do is first talk about what valuation was like before COVID, just so everybody has a quickie education in that. And then share some of the things we've learned since then. Sellers are asking us if there are buyers out there, so we'd like to address that. Okay, there they are. Okay. Valuation as we used to know it. Valuation after COVID. Are there buyers out there? And our thoughts on valuation recovery. So. For those of you that have been to any of our workshops on how to buy and sell a business, this might be redundant, but let's start with a big premise that a business valuation's not what it's about in a current business owner's hands. It's about the company's transferable value. So there are a lot of things going on in a way somebody operates a business, and it's how much of that value can be realized by a buyer and what different costs and expenses might they have. Just real simple example, if somebody owns the real property that they are running the business in and somebody buys it, most likely that would be at a higher price, and so the business expenses would be higher. They'd own the real estate, but the company value might be lower because they won't have as much money as the seller had. So we work on a pretty simple but not simple formula. It's the earnings of the business times a multiple equals the business value. Sounds really straightforward and easy, but it's not. What are the earnings of a company? I can assure you if you take 10 different businesses, even in the same industry, all doing the same sales, their financials will not look the same. And what we do is go through each item line by line in a business P&L and figure out which will transfer to the buyer, which will be different. And we do a multiple year history of that to see what the trends are. And then we find a multiple, which is the risk quantifier, and multiply it times that to get to a final value. So many of you have probably heard the term EBITDA, and that is for professionally managed larger businesses. And we regularly use the term SDE, seller's discretionary earnings, for owner-operated businesses. If you've looked on BizBuySell or any of the other business listing websites, they tend to be in SDE format. Larger businesses that would show up on like Axial tend to be in EBITDAs. So what the EBITDA is the bottom line of the tax return before interest on non-operating debt, because a buyer may have no debt if they buy a business, and most likely their debt structure will be totally different than a seller's. So they can add that interest to their bucket. Taxes, if a business is paying taxes. Depreciation and amortization are both non-cash expenses you'll find on a business tax return, but you didn't write a check for. Depreciation is a write-off of your tangible assets, which the IRS allows, and amortization is a write-off of intangible assets, things like franchise agreements or goodwill or non-compete or other intangible assets a company might own. So these are the two levels of earnings. Let's look at how you get to an SDE from an EBITDA. We take the EBITDA, and remember this is for a closely held business. We take the owner's salary and add it back because owners don't always pay themselves fair wages in smaller companies. Small businesses like to use their checkbooks, business checkbooks for their personal expenses. They like to write off cars and cell phones and travel and other such things, as well as health insurance, life insurance, key man insurance. We need to normalize expenses, just like if somebody's going to buy the real estate in a business, they will have a different rent factor, or if they're going to rent it from the seller. So we make that change. And one-time expenses, like if they moved or they had a lawsuit that won't be incurred again, and we come up with the SDE cash flow. Then we multiply it times a multiple, which quantifies the perceived risk based on the likelihood of future income and the replicability of income. Giving you just an easy example, we all used to go to Blockbuster to rent videos. We don't do that too often unless you live in Bend, Oregon. So the likelihood of future income is pretty low in that business. The replicability of income, we like to joke about Michelangelo painting the Sistine Chapel. If you're going to buy Michelangelo ink, probably not going to have a high replicability of the income. This multiple is influenced by quite a few things. It's not the same for every business. And here are just a few factors that enter into it. What's the desirability of the industry? We found that a carpet cleaning business attracts a lot fewer buyers and isn't considered as quote unquote desirable as the organic free trade coffee roaster. If you've got what the sales profile is and the concentration of your customers is one of these multiple influencers. If you have contracts or not influences it. We sold a business, a janitorial business a couple of years back, told them to get contracts. He was able to double the value of his business just by having these contracts. What's your customer base like and what's the stickiness, which means how likely are they to stay with you? How hard is it to leave? If you've got them all tied up in a software contract and you're managing everything in their business, it's hard to leave. If you've got one customer versus 100, that makes a difference. Buzzword, recurring revenue, everybody wants that. What's the competition and the barrier to entry into your business? One of our brokers used to joke he was in the landscaping business. The barrier to entry is 2 nephews and a truck. And that's not true of all landscaping businesses, certainly, but at the very low level it is. Do you have management staff and a labor base? Before, in the pre-COVID universe, people were buying businesses for the people. Do you have a built-out facility with capacity and the technology? Just had somebody buy a business. They were in the same industry, and the facility was twice as large as the one that the buyer was busting out of the seams at. Do you have a great location and a great lease on your business? What's the growth outlook? What's the scalability, and what economy are we in? And size matters. Bigger businesses tend to sell for bigger prices. So the small business multiplier tends to be, this is SDE, 1 to 4. Smaller business, smaller multiplier. Larger business, larger multiple. 2.2 is the national average. Although we were abutting 3 on a lot of the larger businesses pre-COVID, and the rules change for larger businesses and strategic buyers. A strategic buyer may see something in your business that makes it worth a lot more to them than it would be to somebody else. So the next slide is just a really simple example. We have 400,000 in SDE earnings. We calculated a multiple of 2.5, and that left us with $1 million business value. I've got a little footnote. It doesn't include the working capital. Smaller businesses, the ones the SBA tends to fund, often don't include the working capital, but the SBA will help you work and get it. Larger businesses do include the working capital. So their multiples are different and adjusted because of that difference. Okay, that was the quickie review. Don, did you have anything you wanted to add to that?
No, I think that makes sense. What we see, I would just say that what we see is for businesses to get much over a 3 multiple, there has to really be something quite special about them, both larger size and unique profitability, unique market opportunity. 3 tends to be sort of the high end. And down on the low end, we do see businesses in the ones, in the upper ones.
So the question on everybody's mind is, what are we going to see now since COVID? So let's look at that. We've certainly been postulating. Okay, somebody asked, what's the difference between a larger versus a smaller business? Great question. And there isn't an exact definition, and some small businesses are by definition larger, but I'd say 1 million might be the dividing line in certain industries. 10 million, definitely. Don, do you?
Yes, and I would also say that is in many ways profitability, because profitability, in other words, 50,000 in profits and 300,000 in profits are significantly different, although they could both be 1 million in revenue. And so I think on the profitability side, I would say larger businesses, not big business, but larger businesses that would command higher multiples, driving those up, might start at 250,000 in profits, 200,000, somewhere around there, because you'd start to see opportunity for a different type of buyer come in.
That's exactly it. It's more who the buyer is going to be. Is it going to be an individual running it, or a strategic acquirer or a private equity group?
And at 500,000, it sort of takes another step. At 1 million, it takes another step. I'm talking profitability.
Yeah.
SDE.
Okay. So, since COVID, there were different impacts on different businesses, is what we've been learning. There's those not affected by COVID-19 at all, and some might even be doing better. Liquor stores in the Front Range tend to be doing pretty well. Read an article yesterday, why were they deemed essential? They are. Talked to a bike store owner yesterday that's doing really well. Apparently, in all of we healthy Coloradans are just dying to get outside and get healthy. The next level of businesses are those that are partially shut down. Buyers are going to value these cautiously. What they're going to be looking at is the rebound rate. And so I'm going to talk about that on a different slide. And then there are those that are totally shut down. Some can or will reopen, and heightened level of caution on buyer valuation. And unfortunately, some aren't going to be able to survive. And just talked to one of those the other day, and it was a very painful conversation. So let's look at the cream of the crop. Those not affected by COVID are going to be very desirable. The valuations will hold, and maybe in the supply and demand universe might improve slightly. Going to talk about financing in a little bit, but those businesses will likely be able to get finance. And I thought twice about putting this down, but it's like nothing happened in some ways with them. The partially shut down businesses. So the valuation is going to depend on how fast the business can rebound and if it can operate at full capacity. We've all been watching, the state came out with some guidelines yesterday on restaurants, and I'm very happy to hear, asking for input from the restaurant community on it. But as Don and I, both having sold many restaurants, know it's going to be tough financially if they can't get somewhere close to their old numbers or reduce their costs. Financing is going to be on a case-by-case basis, subject to assumptions and scrutiny. I'm going to talk a little bit about that later. The buyers and the lenders are going to be really analyzing the current monthly financials and the prior period comparisons. So it's necessary to have good books monthly and have those done if you want to sell. The next thing is something we haven't run into a lot. The larger businesses that we used to talk about tend to sell on projections, pro forma projections. So you would figure out what you think the business is going to be doing in the future in terms of sales, expenses, and profitability, and then you would discount that back. For the first time, we are seeing the Small Business Administration lending looking and expecting pro forma projections. And these can't be just hockey stick. They've got to be really well thought out, really well documented.
Suzanne?
Yes.
I would add on that, when you're doing a pro forma projection like that, in fact, if you are overly optimistic, the SBA will look at it very unfavorably and wonder if you're actually qualified to take over that business if you don't have a reasonable expectation of its future.
Yeah, flat is the new growth. So, in these businesses, you can expect some deal structure creativity, and that's coming in a little bit. Okay, those that are totally shut but can reopen, it's to what extent will they be reopening? As we indicated, there's a lot of businesses that aren't going to make it, we don't think, on socially distancing reduced income. Can they adapt? This is the Darwinian thing, survival of the most adaptable, not the fittest. So if you've been running and biking, doesn't mean you're going to survive. Definitely expect creative deal structures or distressed prices. It's going to take time to get back to the previous values. If you're a seller, you've got to decide, is the time or the money more important to you? Can you last? If you've got the working capital and the staying power to last, great. If you got a month or two left, you probably aren't going to find a buyer. And if you do find a buyer, it is definitively going to be at a distressed price. So those totally shut down and not reopening. Hopefully they've got some tangible and maybe some intangible assets that they can sell. If you're back to the restaurant industry, the market is likely to be flooded with restaurant equipment. That value is best in place. Sometimes customer list. What other kind of intangible value do you perceive somebody being able to sell? Patents? Yeah.
You can sell trademarks, you can sell patents, you can sell processes theoretically if you have somebody who's looking to do something similar to what you do.
Maybe accounts. Work that out. Biggest question, what's the status of your lease? Check it and talk to your attorney. Do you have a personal guarantee? If you do, got to work something out. If we're back to a restaurant, this is a fantastic opportunity for somebody to get into a restaurant inexpensively, potentially. Built out facility, maybe they'll be able to negotiate a better lease rate, take over everything. So might be able to get out that way. But if you can get someone to take it over, that could be good. And then like the person I talked to the other day, that was the sad story. Fortunately, they'd already talked to a bankruptcy attorney and were kind of resolved that that was their best issue. And I had to agree with them. So we've been trying to decide, how are we going to approach valuation at this point? So we decided let's look at what the pre-COVID-19 valuation was. That's a good place to start. And that's assuming that the seller has the staying power to hang in there for 6 months or more.
And Suzanne, if I can just jump in really quickly to say, when we describe this as we've decided, I would like to just make sure everybody understands this is a very informed decision, because we have had significant amount of interaction with lenders, brokers across the country, and other experts, so that while there might be some differences of opinion, there's a lot of great professional information that we've been able to package into what you're talking about here. We didn't just decide, we really saw that these are trends and opportunities.
Mm-hmm. And then we've had great debate in our office, and we decided that the multiples should prevail. It's the earnings that might change on the business. And so we intend to try to structure deals on what was the value before. Can the business rebound to justify that? And can we create a deal structure that will allow the buyer to survive and give the seller a chance at the best value? And the business is going to have to perform. And the seller is going to have to be comfortable in who their buyer is, and that's the buyer that has the best chance of getting them the best price. Don, any further comment on that, or?
No, I think that's right. I just back it up.
Okay. So in financing a business purchase, this is kind of like the laws of physics. There are 3 legs to this stool: cash from the buyer, bank financing, and seller financing. So we have historically always wanted the buyer to have skin in the game, have some cash in. Buyers have less cash these days, or even if they have it, a lot of them are less willing to put up as much cash. But we think the buyer does need to make a contribution. And for purposes of this webinar, it's too short a time to go into it, but there are quite a few different ways to get cash if it's not just in your bank account. So if you want to talk about that, call us. So going back with you got too fast on me, Paul. Bank financing. We were very happy to have a great conversation with Renee Wood from Wells Fargo Lending the other day, and the banks are back in business, at least some of them. And so that's good news to us. I'm going to talk a little bit about that. But in the smaller businesses, historically, SBA financing has been the best way to go. There are other lenders out there and people coming out of the woodwork for third-party financing. And that will be an evolving situation.
Suzanne, to answer the question of where did the banks go, why are they back in the game, it was all of the huge number of PPP and other loan programs that were run through the SBA. It took all of the bank resources to get those processed in action. And so they were just basically unavailable to really participate in standard bank financing for business acquisitions.
And I think they went into shock mode just like everybody else too, so.
Absolutely.
And then seller financing. Seller financing has been around since the dawn of man. It's where the seller would carry a note on the business sale and participate in the financing. And I got a little, some good information on that coming up. So most likely, your deals will involve 2 or 3 of these legs of the stool, depending on your situation. So the status of banks, as Don just told you, they're lending again after the PPP loans. And we weren't sure that they would. They weren't sure, but it's been decided that the 7A SBA lending program, which is what finances small businesses, is really valuable to the economy. Supposedly, the small businesses hire 48% of the people in the country. The good news is there's still $100 billion left in the coffers of the PPP. What we were afraid they were doing is taking all the small business lending money and giving it to the PPP, but the second round of lending hasn't gone as fast as the first, and there's still $100 billion left. So yay. As we indicated, the lenders are going to be working off of projections. And so you may need to involve your accountant or other people to help you prepare those. There are definitively going to be higher levels of scrutiny on both the business and the buyer. Definitely on the business, and the metrics are going to change. 3 months ago, with the right buyer, with the right credit, right background, we could get as little as 10% down, SBA financing 80 to 90%, seller maybe financing 10% pretty easily. Now, the buyer is going to be under a microscope. Just because you've eaten at an Italian restaurant, you can't buy one. They have to have relevant, transferable experience to run that business. And previously, the SBA didn't care that much about the cash reserves of the buyer to have some cash left after they put their down payment down. Now I believe they're looking for something like 10% in reserve. Did you hear anything more on that, Don, or want to add anything?
No, my general comment, though, on the lenders, we've now, in addition to Renee from Wells Fargo, we've talked to a large number of them. They actively are looking to find deals. The SBA Guarantee Program is all about helping businesses get sold. So I think even though they're going to maybe tighten the screws on some of these things, I think what we're seeing is they're trying very, very hard to be supportive in the loan environment.
And we've been trying to kind of see who's lending right now and not, so we've got a list. So, and it's certainly not complete, but certain lenders have told us they're temporarily out of the game, certain ones are in, and we'd love to share that list with you. Okay, so on the positive, the SBA has some new exciting programs in place. The 6-month payment holiday is a big one. If you can get your loan closed and funded by September 27th of this year, you can get a 6-month payment holiday, no payments. That's like getting 5% off of a 10-year loan. So, and if you, that can be pretty significant. They're trying to negotiate bank guarantees to 90%. What is it, 75% currently? We're hopeful, but that's not through yet. Financing is never going to be cheaper. We were blown away by some of the rates we heard, some sub 5% rates, depending on the business, the term, etc. But again, borrowers are going to be subject to more stringent qualifications. So that's for the businesses that can be financed. But not all will be able to be financed. We always like to sell businesses that could be SBA financed and get the seller a really large percentage of the sale or all of it at closing. And that's not going to happen as often in the future. Depends on the business. We think the sellers are going to become the lenders. And this enters into it. Buyer's asking, or someone has a question, buyer needs 10% in reserve. 10% of what? I think it's 10% of the business value. So going back to sellers becoming lenders, there's a number of ways they can do this. Promissory notes. This is a very traditional way. It's a pledge from the buyer to pay the seller. It is typically collateralized by the business. It has terms and default terms and everything else spelled out. Attorneys negotiate it. Earnouts. I'm going to go through each of these categories. That's another one. Forgivable promissory notes are surging in popularity. We're going to see, we think, assumption of the receivables and payables on businesses as financing mechanisms, and assumption of debt and leases. So let's look at what these each look like. Promissory note, it's a loan from the seller to the buyer. The amount, terms, conditions, collateral, and recourse are all defined. In the small business sales, they're usually personally guaranteed. So the buyer is on the hook, their assets are on the hook. Larger businesses, if you sell a business to Kroger, there isn't somebody there that's going to put their personal signature on it. Historically, these notes were a smaller part of the sale, and so the business was the collateral. If the SBA was involved, the seller, if they had a note, was in second position. But in the new world, the new normal, maybe outside collateral is going to come into play if the down payments are low, if the down payments are below the asset level of the business. This is yet to be seen. So earnouts. This is where all or part of the business price is determined by the future sales, gross profit, or net income of the business. So it is how the business did in the future was how the buyer was going to pay for it. The weakness here, you're very dependent on the buyer and their skills and their honesty in reporting as well. And so they weren't wildly popular. They were usually a gap to bridge a difference in opinion on value, or a case where the business was hard to value. They may have had a loss of a major customer, or they may have just taken on a whole new line and we didn't know what the earnings of the business would be. And so it was a way we dealt with that. You can either have a maximum price, which is capped, or no limits on this earnout except time, which rewards a seller for laying certain groundwork. A note, the SBA will not allow an earnout. So if you're doing a deal with them, you have to figure out a different way to do this. Adjustable seller notes are coming into vogue. And there's about 4 different terms on this. It might be called a forgivable promissory note, an earn down, a clawback note, or a reduction note. The industry hasn't decided on the term yet, so we're calling them all. This note can be the total price or part of the price, but the buyer only pays on the note depending on the future revenues or other metrics of the business that the parties define. So this is probably going to be very popular with these partially shut down sales. If you're selling a restaurant that used to be doing $1 million in sales and they're only able to do 800, the buyer doesn't want to pay for the business based upon the $1 million in sales, but the seller wants the opportunity to get there. So they'll negotiate something on that. The business, a restaurant, obviously has a high level of tangible assets in place with the value. And then you try to negotiate the goodwill in this note based upon the profitability, which is based upon the sales. We don't like to do things on net income. It's just so hard to manage what net income is in a business, and everybody runs their books differently. Don, anything to add?
Oh, I wanted to reinforce that last statement, especially, that the nice thing about revenue, especially if you're looking at a business that's had kind of historical margins, historical gross margins, historical product costs, service costs, things like that, you can come up with some reasonable expectations or calculations if the business is going to be 50% as big or 80% as big or 90% as big. You settle on that, kind of understand the profitability, but really the key thing is revenue, because that's just one simple number. It's easy for everybody to get to. You either sold $800,000 worth of product or you didn't. And you can have that structured over a period of time. So let's say your seller note is $1 million. Suzanne, I don't know if you have this coming up, but let's say you're doing a seller note of $1 million to be paid off in 5 years. I'm going to pretend there's no interest, 200,000 a year. You can have that forgivable, some percentage or all of that 200,000 based on the activities in that year, each year that it's going to be repaid. So you might have some years that it is and some years that it isn't repaid.
Yeah, and a lot of people deferring the start of the note for a year because this year's, well, 2020 is the year that never happened or maybe never should have happened.
Right.
So this is kind of complicated, so use your chat button if you have any questions on it, or call us after if you want to talk about it personally. Okay. Another way we see doing deals, I did a deal last year, and it was a service business. The guy wanted to sell it and sell it fast to his employee who had been with him for a long time. The problem with the employee, he had very little money. And so we had to figure out a pretty complicated deal structure to sell the business to this guy. So the seller had set a price and the buyer had agreed upon it. However, it just wasn't going to work. So we started looking at everything. The buyer had no working capital, no reserve. The SBA wouldn't have allowed this deal at all. But the business had accounts receivable. So we gave the accounts receivable to the buyer as a financing mechanism. He also took over the accounts payable. We extended the term of the note to get it to a term that the buyer could afford. So we went from a 5-year note to an 8-year note. The price was increased. The buyer took over all the liabilities. I've got that down with or without creditor approval. And I was hesitant to put this in, but desperate times call for desperate measures. If the creditor does not approve the transfer, the seller is still on the hook for any liabilities. But it's up to you, and if it can make your deal happen or not, definitively involve your attorney in this. But that's a way to get some working capital for the buyer. Let's talk about assumption of debt or leases. So in this case, this business also leased 3 very large pieces of equipment, and they had, I think, 5 years remaining on the lease payouts. The business was paying these leases, so we just had the buyer take over these lease obligations. In this case, we did it without lender approval. They weren't going to approve this buyer. If you've got a business with a lot of accounts payable or a buyer that's pretty weak, you're going to have a hard time getting lender approval. Involve your attorney. You're still going to be on the hook if you're the seller. Know that. But when you put all the pieces of this puzzle together, you might have a deal. And it's got to work for both sides. If you put the buyer into a situation that they can't make the numbers, it's going to all fall back on you. It'll probably be, there'll be a default. They probably won't have paid for a number of months. You're in a worse mess than you are. So you've really got to make sure that this is a fair deal for both sides.
Yeah, I think this is really a period of time where win-win is far better than win-lose scenarios out there. And so I think as you look at this, sellers always have to keep in mind the only way that buyers are going to be able to pay for the business is out of the profits and the proceeds of the business. There's no other additional pot of money. So any deal, any price, any deal structure that gets put together, you've got to be able to run those numbers, and you've got to be able to see that there's going to be enough money to support the lifestyle of the new buyer owner, and there's going to be enough money to pay back the loan, and there's going to be enough money to reinvest in the business. And if you try to strike a deal that doesn't meet those terms, it's just not going to be successful in the long run.
Thanks. That's so true. And it's time to put your ego aside if you're a seller. Throughout the course of my career, I have had so many sellers not want to take a deal because they didn't think it was good enough, and ended up losing everything. Time to be really pragmatic. Okay, are there buyers out there? Yes. We have had a really strong indication of buyer interest. There are people out there wanting and needing to buy businesses. So let's look at that and on some thoughts in recovery. Okay.
Suzanne, I apologize for jumping in here. Do you have a slide that talks about where those buyers are potentially coming from? Because in this current situation, there's one category that always emerges when there's a downturn, and that's people that are either being forced out or choosing to exit from their corporate lifestyles. They've saved some money. They are in a position. This is now the trigger that frees them because they don't see being able to stay in their corporate environment. And so they're strong candidates, and they're looking at businesses that they can buy and run. So that's one category where COVID is actually boosting the number of buyers.
Yep. You're a slide ahead of me.
Oh, I'm so sorry.
No worries. It's a very good point. Okay. Right now is a buyer's time of opportunity. Except for the top tier businesses, it's flipped from a seller market to a buyer market, don't you think?
Yes.
There will be some screaming deals out there. I grew up in an entrepreneurial family, and my father used to tell me, I don't buy businesses, I buy situations. And he loved turnarounds. Plenty of buyers looking to buy. There are bottom feeders out there. If you work with a broker, depending on your situation, you may be at a situation where the bottom feeder is your only option, but we hope to try and see if we can find the best deal for you. So anyway, the deal structure will reflect the economic risk and the seller's desperation. So,
Suzanne, I'll just give you an example. I've got a business that we are, even though it's categorized as an essential business, and even though it's still operating fully, there are some disruptive elements in it, but it's not general economics. We're discounting the business 20%, and we're using one of those earn down clawback seller note terms for an additional 12.5% maximum of the price. So potentially, that's going to be for somebody who wants to step in and take over that business. That's a greatly reduced price for one of those businesses that is still actively engaged.
Yeah, there are some real deals out there. Let's talk about that on the next slide.
But the seller doesn't want to have to be the person to hang around to bring everything back up. The seller has already decided, I'm ready for my retirement. I'm ready to move on. So the seller is accepting the reduction in exchange for that time benefit that you talked about earlier.
Yeah, one of the trends that we are expecting to see is finally the baby boomer tsunami, in which baby boomers want to exit their businesses. And I think this seller falls into that. Um, those sellers have been through potentially dot bomb, September 11th, the recession, local businesses, the flood, and they just don't want to do it again. And they're good businesses, like the one you're selling is good business.
Correct.
The buyers are scared and they're trying to structure their deal around the perceived risk. I was thinking back to September 11th, and when I was selling a quick lube, and my buyer was terrified, and he called me and told me I was trying to sell him an obsolete technology. And I said, "Do you mean the internal combustion engine?" And he said, "Yes." I wasn't going to sell that business to that guy no matter what I did at that time. And he bailed. I had 5 deals that evaporated the second the planes hit the buildings, unfortunately. To your point, Don, unemployment's high and there will be people needing to buy jobs. Back to that carpet cleaning business we had for sale last year, which was a really great business with really great cash flow, but it was unsexy. And unsexy is the new sexy, maybe. It's people are, carpets are going to get dirty at a continuous rate, and people are looking at those businesses a little bit differently now. If you're an existing business and you've got the resources to do so, this could be a great time to buy a competitive or complementary business and add it to yours. Hopefully, maybe cut some cost, increase profitability, have greater product or service offerings or geographic offerings to your current business. I want to put a note on that. Acquirers will only place value on what they can't replicate on their own. So if you're a service business that's just on a one-time shot, whatever, you're cleaning houses, you don't have any contracts or whatever, that's less valuable. They can do a marketing effort at some price. They might buy it, but they'll want to buy it just based on the transferability of the accounts. The other thing is buyers, as we've said, have had less cash or will not be willing to spend as much cash. People are hanging on to their money if they can. So expect that if you're selling. There are other ways to get money, as we've said, than just cash in your bank account. So a seller takeaway. You need to understand your value proposition in order to effectively sell or exit your business at this unprecedented time. Please get professional advice, attorneys, accountants, brokers, wealth advisors, whomever. So we've been in business since 1986. We've had, our good times and our bad times, our hills and our valleys. We're confident the sun will rise again. We will find our way to a new normal. It will be different. The laws of physics and business valuation will prevail. Call us to talk to us about your unique situation if you like. We'd love to open this up for questions. And if you have anything else you'd like to add to that, Don, but okay. Yep, we've got still 9 minutes left in our hour. If you want to ask anything, please use the chat button to submit questions.
My only addition really is just to, again, reinforce that there have been difficult times, and we've always found even ground again to come back. I do think the multiples, I'm talking to other brokers, I'm talking to lenders, I'm talking to different people. The multiples aren't changing. There isn't really a reason to change the multiples because the multiple reflects other characteristics. It's the earnings that are going to move. So if the earnings are going to be lower, then the multiple the same, overall the price is going to be lower. So just, I think we don't expect to see them. I would tell buyers, no, it's not going to move from 2.5 to 1.7. You're going to look at the business in a new light based on the earnings.
Yeah. We've had a couple questions. Will the slides be available on the website? Yes. Do you help prospective buyers source opportunities, or are you strictly focused on the sell side? We are sell-side brokers with rare exceptions. We were recently working on a buy-side engagement, but it was for a strategic business owner with a definitive set of criteria. And we were able to identify about 150 businesses that were targeted to his unique situation. If you're just, I'm out of a job and I want to buy a business, we do put on a how to buy and sell a business workshop, and probably will be putting on some things on how to find a business in the coming times, but there isn't a multi-list in business sales in Colorado like there is for home sales. Paul is telling me BizBuySell is a great place to start looking, and the other business listing websites, and look at the brokers, get to know the brokers in your market and talk to them about if they have opportunities that might fit you. And every broker has a whole cache of businesses that have not listed yet that they're working with. And you might be able to, the right buyer coming by might be a great opportunity for a broker to get that seller to engage. One of the things I'd like to say is we put this on first time doing it. We'd love any feedback you have on what you thought about it, what we could do differently, improvements. Okay, guys, if nobody else has anything else, thank you very much. Thank you, Don. Thank you, Paul. Appreciate your attendance. And good luck to you with your futures.